time. Welcome, everyone. My name is Ellie Garrity, and I'm the manager of alumni career programs at the Alumni Association. We're so excited that you're able to join us for today's Maryland Masterclass, which is a virtual series exclusive to members like you that hosts high-profile Terps focused on professional development, personal improvement, and financial guidance. Today's Masterclass, Money with Mac, is hosted by alumnus Mac Gardner. Wave, Mac, how you doing? Mac Gardner, he's a certified financial planner. Oops, looks like I was muted. Sorry about that. Mac is a certified financial planner, and he's served in the financial services industry for more than 20 years. He's a published author of 2 books, Motivate Your Money and The 4 Money Bears, which he will tell us a little bit more about. Mac also serves as the founder and chief education officer of FinLit Tech. His company's mission is building a bridge between financial literacy and financial technology. His firm has recently entered a partnership with eMoney Advisor to collaborate in the development of their new financial education and wellness platform. Okay, a few housekeeping items before we begin. This event is being recorded today, and I ask that you stay on mute throughout the duration of Mac's presentation. His presentation has been catered to your previously submitted questions, but if you didn't submit a question ahead of time, there is still plenty of opportunities for you to engage, so feel free to submit your questions through the chat function on the bottom panel of your screen. All right, that should be it from me. I will pass it off to you, Mac, to get things started.
Thank you so much, Ellie. Thank you, everyone on the call today. I want to thank you all sincerely for allowing me to share some of my thoughts, share some of my experiences in the financial services industry as a lifelong learner. It's a great field to be in. And for those of you who are on the call, go Terps. So let me start off this way. I have served in the industry for 20 plus years. I have served as a commercial lender, a trust administrator, retail banker, private banker, a high net worth, ultra high net worth specialist. And so I feel very fortunate today to be speaking with everyone, to be able to share some of the experiences that I've had and continue to have to help people along their financial life journey. So a little bit of background about my first 2 books. My first book, Motivate Your Money, folks can see it right here. I wrote this about 6-7 years ago, and I wrote it because I had been working with people doing a lot of financial planning. And it was just very eye-opening that I was working with people that were, millionaires, that literally had a lot of money. But some of the financial planning concepts were relatively new to them. And so I started doing some more digging and finding out that though people were doing very well and had great jobs, our society as a whole really doesn't do much along the lines of financial literacy and financial planning. In fact, a stat to share with everyone, today, as of 2021, there are only 21 states in America that provide any sort of financial literacy education requirements by high school, right? So think about that. You have to be lucky to live in one of these 21 states, and if you don't, it's too bad. And another interesting fact is that financial literacy, financial education starts by age 7. Studies show, it's actually a Cambridge study that shows that a child's connectivity with money starts by age 7. So if it starts by age 7, but we're not getting any guidance by
Mac, looks like you are muted. I'm so sorry.
Was I muted for the whole time?
Absolutely not.
Okay, good.
It was your last little thing you were saying of children start to have a relationship with money around 7 years old. Sorry, everyone.
Exactly. So a Cambridge study was recently done that shows that a child's connectivity with money starts by age 7. So we as a society need to have a lot more financial education, a lot more financial literacy in our schools. And so this has been something that has been a passion project of mine, not just to help people manage their financial affairs, but to actually help when it comes to educating people and starting that education process as early as possible, which is how the 4 Money Bears book came to be. So one of my clients came to me and said, Mac, your first book is awesome. Great Mac nuggets, as I like to say, little tidbits to help you get through your financial life journey. But would you be open to creating or writing something for kids? And so I talk about the 4 functions of money. There's only 4 things you do with money: spend it, save it, invest it, or give it away. And so that's how the 4 money bears came about. So our firm, FinLit Tech, as mentioned earlier, our mission is to build a bridge between financial literacy and financial technology, and utilize technology to really get the word out about financial education and how we can help folks. So when Ellie reached out and said, Mac, we'd love to put something together. This is a very hot topic with COVID. We're seeing a lot of folks, having questions, maybe facing financial difficulties due to COVID-19 and due to a lot of different things that are going on in the country. Would you be open to putting something together to address financial planning and financial education as a whole, as well as answer some questions from folks? And we've already got a couple of those that are teed up. So we're going to go through this presentation. I'm going to start it off now. This is just a cover page. All the letters after my name simply mean I spent way too much time in this business. But for those of you that are looking with the acronym, so I am a certified financial planner, a certified wealth strategist, chartered retirement planning counsel, as well as a chartered retirement plan specialist. So again, that just means I've spent way too much time in this industry helping people deal with their money. As you can see there, founder and chief education officer of FinLit Tech, and author of 2 books. And more importantly, a Maryland alum. All right, so let's look at the next page here, shall we? All right, many of you here are on the call are at different stages of your financial life. And a lot of times when people are looking for guidance, they will turn to a financial advisor or a financial planner or someone that can help them manage their finances along their financial life journey. This page here, what I'm trying to show or share with everyone here is the importance of prioritizing, right, the important elements of your overall picture. So a lot of times when I sit down with clients and we're going through this, what I call the initial discovery meeting, the first thing I talk about is family, right? And the reason why I speak about family first is because typically that's what's driving a lot of the financial decisions that we make. Children in the family, your spouse, parents, family members, all these different folks are impacted by the financial decisions that we make. So the first thing we want to look at is look at your family and look at your family dynamic, all right? Once we've sat down and we understand who all these various financial assets and accounts and things are working for, right? Then we can take a look at the actual finances, right? So if you're sitting down, if you're working with an advisor now, that's great. I think it's very important to have someone that you can trust to, again, help you along your journey, because it is a very, very complex one, right? If you're working with someone, great. If you're not working with anyone right now, I strongly suggest that if you are if you're actually going to do some introduction meetings, or if you're going to interview any financial planners, make sure that they ask about your family. Make sure that they're really trying to understand your whole picture. There's an old saying in our business: people don't care how much you know until they know how much you care. All right, and I really try to live by that as a certified financial planner myself. Then you start looking at your finances, and when we look at finance, we look at assets, liabilities, income, expenses, just to get a big picture of where you are now, right? We need to be, in order for any advisor to give you advice, give you guidance, we have to understand what your current situation looks like in order to give any sort of alternatives, suggestions to where you should go moving forward. And then we look at the future, all right? And when we talk about future, I like to break it down into sort of a 1, 3, 5. So what do we want to accomplish a year from now? What do we want to accomplish 3 years from now? What do we want to accomplish 5 years from now? Now, for some folks, retirement would be really, really, really far off. We can talk about it. We can get some ideas, right? But if retirement is more than 20, 30 years, it's important to really take chunks of time and make it more manageable, and look at a 1 year, a 3 year, and a 5 year. And do we want to eliminate student loans? Do we want to save up for a home? Do we want to save up for a vacation? Are we looking at a new home? Are we looking at a boat or whatever it may be? But we want to look at our goals. We want to really make them easy to manage. So that's why we break them down into 1, 3, and 5 years. So remember, family, finances, and future. And then you're at the center of that. You and your family are at the center of everything. So as I was putting together the first book, I was looking at trends and looking at things that the people that I have been working with. So just as a matter of fact, I've presented over 4,000 financial plans in my career. All right? And the trend that I saw from the people who have worked hard and diligently over their lives and had financial success over time was actually a 5-step process. The first step was to plan accordingly. And by plan accordingly, meaning having a plan. There's another Mac nugget like to share that people people may plan to fail or they fail to plan. That's pretty much how it is. So have to have a plan. Second, spend cautiously. So being aware of every dollar that's coming into your household and going out. Save diligently. So if there's a way to automate savings in your life, a 401k, after-tax account, savings account, if there's a way to save diligently or automate savings in your life, definitely do that. Step 4 is investing wisely. Now, typically that requires a little bit more help from a financial advisor, someone who's a licensed professional that works in that space. The folks that are on this call, you all go to work every day and you do what you do and you do it very well, right? It's tough for you to manage, your portfolio of your bonds or your stocks or your ETFs and looking at risk tolerance. It can be very challenging unless you just like doing it. So that's why it helps to have a professional or have someone that you can trust to help you manage your investment assets and do it wisely. And the last step is to give generously. So if we can follow those 5 steps, all right, over time, what I found was the folks who did this, they ended up doing pretty well over time. They retired and had retirement assets, and they paid off their home, and they were able to fund their college savings for their kids. So the 5 steps to achieving financial success, again, are plan accordingly, spend cautiously, save diligently, invest wisely, and give generously. And it just so happens that 3 of those 5 steps can start very early. And that's what the 4 money bears is about. So spending, saving, investing, gifting, again, the 4 functions of money. All right. So I believe, Ellie, we have some polls, correct?
We have some polls. You let me know when you're ready to launch.
All right. So let me give you an overview of what this image is here, and then we can jump to the poll. All right. So as I said before, financial planning can be complicated. All right. A good advisor, good CFP, should be addressing these 5 important areas of your financial life. All right. The one that gets a lot of attention are the investments. All right. That's typically where folks are saying, "Hey, Mac, what did the portfolio do?" Or, how did you do versus this? And what's the Dow Jones doing? What's the S&P doing? A lot of different stuff. That gets a lot of attention, and it is important. But there are 4 other very important aspects. There's the insurance aspect of your life. So there's protection planning. A lot of times we can spend so much time looking at growing your money, all right? But if something happens to you and disability becomes a factor, what happens to your overall plan? If you, die unexpectedly, what happens to the overall financial plan? So we have to address the protection planning or the insurance aspect of your financial plan. We need to look at the tax management side of it. Pretty much every action or every financial event that goes on has some sort of tax implication, either income or estate or investment tax. So we have to be wary of that. And then we look at the retirement aspect. The retirement for a lot of folks is a big piece of the pie, because we may not be getting a pension. Pensions are going away. And so now the onus is on top of us to fund our own retirement. So we've got to know how much to put away. We've got to know how to manage it. And if we're lucky to have some money, we got to know how to make that money last for the rest of our lives. And of course, that last part there is your estate plan. Are your wills in order? Do we need a trust? Do we need more complicated trust documents? So all these are 5 areas that we want to address and that should be addressed when working with a financial plan. So the first poll question, there is no wrong answer. There is no wrong answer. I'll say that now. Ellie, if you could share that with the group so we can get some feedback, that'd be awesome.
Okay. Poll question number 1, which area of the financial planning process is most important to you today? So go ahead. This should have popped up on your screen. We have investments, insurance, retirement planning, taxes, and estate planning. And I don't know if you can see Mac as the responses
I
come in.
can, yes, this is pretty cool. This is neat, this is neat.
We'll share them with everyone when the polls close. We'll just give another minute or two, but looks like retirement planning with over 40. Oh, it's going down. Let me not speak too soon.
We've got a race going here. It's like retirement planning versus investments. Who's going to win?
So if you haven't gotten your vote in, we'll give you another second or two, and then I'll close the polling and share the results so we can all see where people are today. Great. Okay. So I'll share the results. It looks like retirement planning has won with investments in a close second.
So that's not surprising at all. Again, because retirement planning nowadays involves a lot more moving pieces, a lot more moving parts. Really not surprised to see that. And because one of the bigger drivers of the retirement planning conversation is how your assets are invested to get to retirement. Not surprised that investments is in a close second. Typically, those are the two responses that we get. So great. So we know we're talking to the right audience, Ellie. We know that folks here on the call are going to have questions, and we're going to be able to address some of their questions or their concerns as we move forward.
Great.
All right. Next. Should I close or do you close? Who closes that poll?
Oh yeah, if you just hit the little X, and this is for everyone. If you hit the little X in the top right corner, then poll will leave your screen.
Disappear. Awesome. All right. So next, this is a good screen, and this is a good point to talk about, because when we asked folks for questions prior to this call, it was interesting to see how divergent the questions were. And typically, what drives your questions and concerns is where you fall on the financial life cycle, right? So if you're seeing on your screen, you see that we start off in our financial lives, we get our first job, we're going through school, and we're working to accumulate things. And so we call that the asset accumulation phase. And during that phase, you're probably looking at, your questions and concerns are about maybe paying off debt, maybe, growing your emergency savings. What are the best investments to start investing in your 401k? So those are really questions in your asset accumulation phase. Right? As you progress through that phase, you get to what we call the asset preservation stage. So there's really no age. People ask, well, Mac, what's the age? It's not depending on age. It's really depending on where you are in your financial life. Now, typically our folks in their peak earning years, in their sort of late 40s, early 50s. Typically that's, statistically a fact, but it really doesn't matter where you are age-wise. It's really what your focus is. So once you get to the asset preservation stage, you're sort of looking at the situation where you're building your assets, right? And you may have your home, you may have investment accounts, you may have a business, you may have various things that are in your financial life that you're looking to preserve and make sure that you don't lose. And so your perspective changes a bit. So instead of getting more aggressive and looking to really grow the assets, you're looking at more of a balance of growing, but really protecting, because you're realizing that you're going to need these assets soon to get to the next phase, which is the distribution during life. Right? So distribution during life is, so typically what we're seeing is when folks are looking to exit the workforce and enter into retirement, whatever that may look like or may be for that person. Retirement is changing a lot. Folks are, interesting stat. In 1950, the average retirement age in America was 65, right? Life expectancy was 70. So think about that. you only had about 5 years, right, to accumulate assets, and then a pension or Social Security works, and then you pass on. Today, retirement is a little bit younger, in between 63 and 64, but life expectancy is 85. So we have a much larger time frame to have to fund retirement. So that's what that distribution during life phase is. It's becoming very tricky because of longevity, because of low interest rates, because of lacking of pensions or corporations giving pensions. So that space is becoming a hot topic. Another interesting fact, there are 10,000 people turning 65 a day for the next 20 years. All right. So there's a lot of folks that are going to be entering into this distribution during life phase. And so a lot of planning is going to be needed. And so that's why working with a CFP or working with an advisor who works in that area is going to be very beneficial. And then the last phase is distribution at death. So you're fortunate enough to have these assets. At that point, you're looking at how do we get our stuff, our assets, our accounts, our home, all these various things to the next generation tax efficiently. So those are really what are going to be the drivers of the questions that you may have in your overall financial plan. And the cool thing is there are advisors out there that work and specialize in all these different areas. So I think we have a second poll question, Ellie, yeah?
We do.
All right, so let's ask folks out there who are participating. Poll question number 2.
Okay, number 2, which part of the financial life journey is most important?
And I'll say again, no wrong answer.
Asset accumulation phase, the asset protection phase, distributing assets during lifetime, and distributing assets at death. We have another horse race going. Be sure to get your votes in. We'll give folks just another second. Okay, if you haven't already, get your last minute votes in. Okay, I'm gonna end poll. Share the results.
All right, so not surprising. Yes, the asset accumulation phase is pretty important, and more importantly, it's the most important to the folks on this call. And you're right. If you don't have anything going at that phase, and something I like to share with my clients is that you can't eat tomorrow what you didn't plant yesterday, right? So the important thing is to start the process early, start the savings early, start the investments early. If your company offers a 401k, some sort of retirement account, start that process early, and just start accumulating. Take advantage of time. All right, that's the one thing that could definitely help you. And then as you move through the various phases, again, I think second place was the asset protection phase, which is very important. And then then came to assets distribution and lifetime distribution and death. All right, great. All righty, let's clear that one out. And then let's go to this page. Okay. So some of the questions that we received earlier prior to this call surrounded around investment tools. All right, so I wanted to take a few minutes and share a risk reward graph that I would often share with clients, prospects, or folks, just when it comes to getting an idea of what's the right type of tool, how does that act, and to give you a sort of risk reward ratio here. Now, as you can see here, we've got the reward, we've got the risk. In the lower left is low risk, low reward. So what fits in that space? CDs, cash, savings account, money markets. Those are low risk, low reward investment vehicles. All right. Now, there is low risk and there's low reward because we're in historically low interest rate environment right now. They're a lot lower than they may have been maybe 10, 15 years ago. But just know that that money is going to sit there and it's going to chug along and it's going to just be there when you need it. Great for emergency funds, great for short-term goals, less than a year. That's when we look at things like CDs, cash, and money markets. The upper right is high risk, high reward. So That is your Forex, that is your Bitcoin, that is your cryptocurrency. Those are things where, yes, is it high reward? It's definitely high reward. But if we even were following what's been going on with cryptocurrency in the past week, when Bitcoin was at $60 or $60,000 a coin, I think now it's down to 32. So again, very risky. I would not suggest that any person puts a large portion of their savings, long-term savings for retirement, into that quadrant. Can you have some portions of your money into that? Sure. Just be aware that it's going to be very, very volatile. So stocks, right? Question, Ellie? Do you have something?
Oh, wow. Thank you. You caught that. We had a quick question in the chat I wanted to get to before you moved on, but could you describe what Forex is for some of the folks on the call?
Oh, sure. So Forex is as foreign exchange. So Forex is the market where currency is traded. So you can, if there's a market for it, there's a market for pig bellies, there's a market for gold, there's a market for currencies, there's a market for cryptocurrencies. So Forex is a means of trading currencies from around the world. Right. And so stocks can fall way within the scope. There's some stocks that are small cap stocks, and small cap means small capitalization, means they're smaller businesses. Those are typically a lot more volatile. They do a lot more of that, right? Then you have your large cap stocks, which are your big companies. Your Exxons, your Coca-Colas, your large companies. Those are called large cap or large capitalization stocks. And those, they may be volatile, but they're not as volatile. They don't move up and down as much as some of the other stocks. And then you have bonds. There's an adage in our business that says stocks to get rich, bonds to stay rich. So bonds do not move anywhere near as much as stocks do. Bonds they pay you a coupon, or they pay you a dividend. And so if you're looking for income in your portfolio, you would be looking at maybe having more bonds that provide that, or dividend paying stocks. Okay. So just remember, when you're looking at the assets and when you're looking at, okay, where should my stuff be? You're going to be looking at in investment terms, something called a beta. Your beta is your volatility, how much it moves up and down on any given basis. Low risk, low reward, good for short-term goals. High risk, high reward, things that are moving a little bit further out on that graph are better for long-term, because you have time to make up should you have a big drop. If you don't touch the money, you can buy it when it's going low and go back up. Then got a little bit of Warren Buffett in here, everyone's favorite investor. And he says, one of his favorite quotes of mine is, be fearful when everyone is greedy, and be greedy when everyone is fearful. All right. So if you see a lot of folks running towards something, I like to tell my clients, if you see folks running towards something, you missed the beginning of the parade. The parade began and started already. So hopefully this helps folks get a better understanding as to what they should invest in and why they should invest their money in certain places, at least to get a risk reward perspective. How are we doing on time? All right. Okay, so we've talked a little bit about starting the financial planning process. We started talking about making sure that your family dynamic is addressed, and looking at your finances, and then looking at the future. We talked a little bit about the 5 steps to financial success, planning accordingly, spending cautiously, saving diligently, investing wisely, and giving generously. All right, we talked about where you are on your financial life cycle. If you're growing and accumulating assets, you want to have a portfolio that has a little bit of everything, some stocks, some bonds, some cash, depending on how far along the goal is. And we talked about the various stages of, growing, protecting, distributing during life. I mentioned earlier that this stage, the retirement phase, is probably one of the most complicated aspects of the financial planning process, because think about it. You're working for 20, 30 years, all right? Let's say you start your first job when you're 20, and then you go to 65. So let's just say you've been working for 45 years, and you're accustomed to having a paycheck coming in, and you're accustomed to living off of this income to, pay the mortgage, pay for the car, pay for the vacations, pay for the kids. That's the lifestyle that you've been accustomed to. Imagine now coming to this point in your life where that job is no longer going to be providing you that income. You now have to maintain your lifestyle based upon your savings and the things that you've put together over that time. There's a three-legged stool of retirement income planning. So there's Social Security, which as a random fact to folks, Social Security, when initially created, was only created to provide 40% of your income. It's never created to provide the full complement of what you're earning during your earning years. So you got Social Security. You may or may not have a pension, but if you do, that's one part of the three-legged stool. And the other one is your savings, is your personal savings. So imagine now you've reached this stage in your life, you've amassed various assets, and you've got different things on your balance sheet. You've lowered your liabilities. And now you're looking at potentially 20 to 30 years in retirement, right? Because if you retire at 65 and the average life expectancy is 85, that's 20 years right there. And we all know that, may not know, but the fastest growing age group in America right now are octogenarians, which are folks in their 80s. All right, so we're in that phase. So what are some of the things that we need to focus on as we're entering into the retirement phase of our lives? There are five pieces here. It's longevity, market volatility, inflation, taxes, and healthcare costs. So this poll question, Ellie, this one actually has a right answer. So if we could put the poll question up for folks and get some participation and see if folks get the right answer, that'd be great.
All right. Which of the 5 retirement income risks is most concerning to new retirees? And actually, I'm excited about this answer because we had a great question come in from one of your fellow Terps that I think might have a lot to do with this. We'll give folks a couple seconds to get their answers in. Okay, results still coming in. Looks like we might have a winner. One more second if you're still thinking. All right. Let me share these results. So we did get one answer, healthcare costs. What do you say, Mac?
So the answer, actually, that is the second biggest concern.
Okay.
The biggest concern for new retirees is actually longevity. How long will they live? Will their money last as long as they do in retirement? So yeah, longevity is the biggest risk, because if you think about it, that longevity line really affects everything else that you see there, right? Because the longer you live, the bigger impact inflation will be. The longer you live, the more potential market volatility you'll see. The longer you live, the more taxes will be taken out of your portfolio, potentially start down. And of course, the longer you live, right, the bigger the chance that healthcare costs will impact your overall financial plan. And the thing that's scaring a lot of folks nowadays that are entering this phase. So just some facts. If your body starts to break down during retirement, all right, there's 3 phases of retirement. There's the go-go, there's a slow go, and then there's the no-go. So as your body starts to break down, if your body breaks down, typically it's a long-term care situation and you're in the facility 3 to 5 years. If Alzheimer's is the factor, that can be anywhere between 7 to 12 years of care. So there's a lot of things out there that spin off of longevity, which drives that to be the correct answer in this one. But so thank you everyone for participating. You were very close. The top 2 that you have there, healthcare costs and longevity, are the 1 and 2. Longevity is 1 and healthcare is 2. So as you're entering into this phase, try to be mindful of time here. As we're entering into this phase of distributing assets during life, it's going to be important that your plan and the person that you're working with to put your plan together is factoring in all of these different aspects and all these different potential risks, making sure that longevity risk is addressed, making sure that market volatility is addressed. And how do you do that? So for longevity risk, there are tools out there that can provide guaranteed income if you're not going to get a pension. All right. For market volatility, the best way to mitigate market volatility is to not have all of your stuff in volatile assets like stock. So there's something called the rule of 100. So if you take 100 and you subtract your age, okay, your age, so let's just say someone who's 30 years old, 100 minus 30 is, so if you're 30 years old, 30% of your portfolio for a long-term sort of retirement plan goal, 30% should be stocks, 70% should be in stocks. All right. So remember, you've got a longer runway to take advantage of these ups and downs. So you want a larger portion of your portfolio to be invested in stocks, whereas a smaller portion to be invested in bonds, which are more, conservative assets. Let's turn it the other way. If you are 70 years old, right, and you're going to start needing these assets to maintain your lifestyle, to start generating income, you'd want 70% of your assets to be in bonds and 30% to be in stock or growth, because you still want to keep up with inflation. Inflation's chugging along at about 2.5%, 3% right now. So you want your assets to still work with you, but you can't take that volatility. 2008, for those folks who were invested then, I started as an advisor in 1999. So I saw the tech bubble crash and I saw the 2008 crash. And the folks who had overweightings in equity, they lost a lot of money. If you were younger in 2008, it wasn't a problem. But if you were entering into retirement around that time, it would have been very, very devastating to lose 30 to 40 to 50% of your money. So market volatility is important. Healthcare costs, they're tools that can help help you utilize your today's dollars to fund for healthcare costs down the future. Inflation, as I said, sometimes the pendulum swings too far and too conservative, but we have to make sure that your assets are keeping up with inflation. The best way to do that is to have some stocks, some equity exposure. Taxes is one of those things where if you have a lot of your assets in 401ks, IRAs, or what are called qualified accounts, and they're called qualified accounts because they qualify for special tax codes and special tax treatment. Taxes is going to be a big one because you've gotten the benefit of putting money into these accounts, into your 401k pre-tax. You've gotten that tax deferred growth over time, but you got to pay the tax man at some point in time. And typically when that happens is when you're retired. Now, if you're retired and you're in a lower tax bracket, that's great, right? But you just have to be aware of how taxes are going to be impacting your lifestyle, and make sure that if you need $100,000, let's just say for ease of numbers, if you need $100,000 to maintain your lifestyle, you got to factor in taxes if it's coming out of an IRA, if it's coming out of a 401k. So you're actually going to be taking 120, 130 out to get to your net number of 100. All right, so just be very aware of how taxes can impact your retirement phase of life. That's right. So we've covered a lot. I tried hard to grab and touch a lot of different areas here and address different questions that we got prior to this. And so I think for the time remaining, if it's okay with you, Ellie, I'd like to just tell folks a little bit about where they can find our cool stuff, and then we can get into some Q&A. Is that okay? Yeah. All right. So Motivate Your Money, our first book, you can go to www.motivateyourmoney.com, learn a little bit about the book there. The 4 Money Bears book, our children's financial literacy platform, you can learn about it there. Both books you can buy on Amazon, like everything. And then our company, FinLit Tech, if you want to learn a little bit more about our mission to build that bridge between financial literacy and financial technology and get involved there, you can learn more about us there. Go Terps!
Yay. All right, Mac. So I am going to try to take some of the questions we got in advance. And then of course, feel free to chat your questions in the chat. But I want to go back to what you were actually just chatting about. We had someone type in a question that was kind of about they're close to retirement age, and healthcare seems to be, from his perspective, kind of the biggest expense for older folks and can be the biggest cause of bankruptcy. That's what he was told. So could you dive a little bit further into maybe some insight or some advice you have for some folks who are really going to have to dive into some of those Medicare related decisions soon?
Yeah. So that's a hot topic. So baseline, 65 years old, that's when you qualify for Medicare, right? And that's when you can go and you can sign up, and they've got all the various supplements, so on and so forth. What we see a lot of times is folks who want to retire before they qualify for Medicare, and we call that the bridge. So let's just say that you want to retire at 60, but you don't qualify for Medicare until 65. So you've got to fund your health care costs, and you've got to fund your health insurance costs for that 5-year period, right? So that's something that you have to sit down with your planner, sit down with your advisor, and really put together that overall financial plan. That's why financial planning, I believe, is so important and integral to the overall success for folks. Is because if we sit down and we look at your assets, your liabilities, your income, expenses, we look at your current income situation, we look at your current, all these different factors, and we say, hey, are you retiring because you don't want to work? Or are you retiring for whatever reason? It may make sense to maybe work a couple more years, right, to get that done, so that your bridge between now and Medicare is not as big, and it won't be that as much of a drain on the overall portfolio, because it can be very costly.
Great, thank you. Another question, I'm going to try to bounce around to different aspects. I know we have folks with different needs here, but what is a low cost or effort path to buy stocks or, invest some of your money? We got a couple of questions on, I have X amount of money, how do I invest it? And what are the kind of benefits of working with a financial planner? I have a two-parter for you. So what are some ways to do it on your own? And then what are some ways to work with a financial planner? I don't know if you could see the chat, but a couple people are kind of asking how to work with you, or where can you find a financial planner? So
sure. So to find a good CFP, if you go to letsmakeaplan.org, or cfpboard.net. So letsmakeaplan.org is a website that's been created by the CFP board, where you can put in your zip code, you can put in some information that you'd like to learn about having a certified financial planner in your area. So a certified financial planner, for those of you who have not worked with one before, is the industry standard for a financial planning specialist, someone that specializes in financial planning and that can address your investments, your insurance, your retirement, your estate, as well as your taxes. So definitely go to that website, look for a CFP in your area. If folks want to reach out to me and say, hey, Mac, who do you know in certain areas? I have quite an extensive network of certified financial planners that I've known over the years. Be more than happy to help. Definitely look at that. If you're looking to do something on your own, you don't need a CFP to start investing. And so I think what has come about in this new age of technology and innovation. So I like to use this analogy. If this were 30 years ago, Mac would call the phone to, hey, Ellie, what's going on? I'd say, hey, Mac, what's going on? Hey, Ellie, do you want to buy some Xerox stock? And Ellie would be like, sure, Mac, I'd love to buy some Xerox stock. Okay, well, wire over $10,000 and buy you some Xerox stock. Mac made his money, Ellie has her stock, right? About 20 years ago, if we move up a little bit, like 10 years, Mac would say, hey, Ellie, there's this great mutual fund out there that has all these different things in there. Would you like to buy this mutual fund? Ellie says, Mac, yes, this mutual fund sounds good. This mutual fund is a basket of stocks, so I'm diversifying all my different stuff, right? And Ellie sends the 10,000, Mac puts in the trade, we're good. About 10 years ago, there's a new construct, something called an ETF, an exchange traded fund, right? Now, mutual funds are actively traded or actively managed, meaning there's a manager, and typically you're paying a little bit more for that manager to beat an index, S&P, Dow Jones. And so that's what you're paying your money for is that money for that manager to outbeat or to outpace or beat that index. An ETF, you're buying the index. So an ETF is much, much cheaper, right? And doesn't have a lot of volatility because the index doesn't move around very much. And so now if Ellie calls Mac and says, hey, Mac, I'd like some blah, 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 I would suggest we look at an ETF or some sort of low cost, mutual fund, Vanguard, Fidelity. So if you're looking to start off, you can start investing with as little as $25 a month. You can literally go into Fidelity or you can go onto Vanguard, their websites, and you can open up an account and you can purchase a Dow Jones, an S&P 500 ETF or mutual fund that's low cost, no cost, and you just start systematically purchasing what's called dollar cost averaging. So you're buying every month, you're buying your $25, no matter where the market is. That is, I think, the easiest way to just get into this space of investing is buying a large cap index ETF with as little as $25 a month and start there.
Awesome. And tough question for you, but when would you recommend that a financial planner or certified financial planner steps in to support someone with kind of managing their money? Or is there a specific time you think everyone should look into that?
So this is a kind of loaded question, and here's why. Historically, folks have been of the belief that you need to have money in order to engage an advisor or a certified financial planner. And sadly, the industry, it's evolving, thankfully, but sadly in the past, if you didn't have money, most advisors were like, well, okay, if you don't have any money, how can I either charge you a fee or something along those lines? The industry is changing now, thankfully, to where a certified financial planner can engage a client and can charge a fee. So it's a fee-based arrangement now. Almost to the point of a subscription where you can say, look, here's a monthly subscription. We know you don't have the $1 million of assets, but we know folks need help. So there's some certified financial planners out there, financial advisors out there that will work with folks, whether you have $10,000 or whether you have $10 billion, right? But that's why it's important to vet these CFPs and vet these professionals and ask them, hey, how do you get compensated? How do you charge your clients for the work that you do? For some of them, if it's a fee-based arrangement and it's a subscription or it's annually or quarterly, I think we all need help is really the answer to the question. It's just finding someone that you trust that can give you advice and making sure all these pieces of your life are working together. Because if the investment piece is running on its own, but it's not in line with the insurance and the retirement, it's going to be tough. The CFP can make it all work together for you.
I know that was a tough one. I appreciate you taking that on. We got some questions about some of our Terps out there that are parents. Mm-hmm. So, a lot of folks are investing in their retirement. They're also just investing funds for down the road. And then there's also a space for investing in either college funds or, space for their kids. Are there any kind of algorithms out there or recommendations you have in terms of how folks should be allocating their funds if they do want to save for their children?
Yeah. So thanks for asking that question. It's really important, especially since college costs are like skyrocketing 13% per year versus everything else, which is 5-6% or 3-4%. So a couple ways to address the college planning side. They're state prepaid accounts. So we live in the Sunshine State of Florida. Florida has prepaid. So I can find that account and prepay and buy those future units at a deep discount, which is in essence what prepaid programs are all about. So if your kiddo or kiddos want to go to school in that state and that's really what's going on, that's a great way to go. The other alternative is what's called a 529 plan, a college savings plan. And what makes the college savings plan unique is that you don't get a tax deduction for the dollars that go in. However, you get tax deferred growth, right? and the money comes out tax-free for college expenses. Even better though, new recent rules and regulations have dropped it down where you can actually use your college 529 plan to pay for as low as elementary school. So what we've seen is grandparents gift, you can drop 5 years worth of gifting. I think this year in 2021 is $15,000. So each person can drop 75,000. So it's a couple, 160,000. They can drop a chunk of money into a 529 plan for a grandchild. And mom and dad can use those dollars to fund private school for that child if they wanted to, or they could just save it for college and they can utilize it for college. So the 529 plan has evolved a bit and is what we see typically as a tool. I have 3 kiddos. Literally, as soon as they got their social security numbers, I opened 3 529 plans. Like literally, the social security went in, and I went and depending on the platform, ours are with TIAA. They have age-based portfolios so that when the child is younger, it's a lot more stock, and as the child gets older, it needs to be more conservative, and it follows the child's age all the way to 18. So again, those are the 2 preeminent options that are out there. The college, the prepaid is a great, if you know your child wants to go to school in that state, again, it's a very good use of dollars. But if you want to open it up and sort of start investing a pool of money, sometimes we see folks, if they don't use it for college because they get scholarships, they can use those assets to buy a home for the child, or they can move it. And if it's let's say it was little Jimmy that was the recipient, and little Jenny is a sister, they can move they can change the beneficiary of a 529 plan. So you got a lot of flexibility there.
And this may be a tricky follow-up question, but is there any kind of rule of thumb in terms of what you're doing with your monies, in terms of how you're allocating it to your different funds? So if you do have a 529 plan, but you also want to contribute monthly to retirement and maybe, a Roth IRA account, is there a rule of thumb? I know that's hard without seeing someone's portfolio, but
yeah, the rule of thumb really depends on when you need the money, like how far away that goal is, right? So if I've got a 10-year-old and we know that in 8 years, the 10-year-old is going to need to touch this money, I may not have that aggressive a portfolio. It may be a 50-50, maybe 50 stock, 50 bond. I want to make sure that that money's growing. If I'm funding for retirement and I'm 40 years old and I need that for 25 years old, I'm going to be more aggressive. So that's typically rule of thumb. What we're looking at is risk tolerance, is how much you open your statement every month and you're like, ooh, I don't know, no, I don't want to see that. That's your risk tolerance. And then the other important factor is the time horizon. How much time do we have before we need to touch the money?
Awesome. I appreciate that. And this will be the final question. It's a 3-parter. So I kind of made this up on the spot because we have a lot of people who have a lot of different questions depending on kind of where they are in the life cycle stage. So would you be able to share at least 1 or 2 Mac nuggets of wisdom at kind of each life cycle stage? So for our younger folks who are new graduates or early in their 20s, and then, folks that are kind of in the grind of that mid-career level, potentially have some kids. And then again, kind of our folks who are getting ready, preparing for retirement or in retirement. I know that's a lot, but
let's see what we can do. So for the earlier stage folks, begin yesterday. Like literally, you cannot start this savings process for your money early enough. You really can't. And I use an analogy. So our human bodies, we come to life and then we pass away, right? Our financial bodies, Ellie, can last for generations. Think about it. The DuPonts, the Rockefellers, the money that was created, these things that were created generations ago are still alive today. You see what I'm saying? And they're made this way because of proper planning, because businesses were put together and trusts were put together and all these different things. So start the process early. View your financial body and financial life as a business, right? Business, it's all about cash flow. Cash flow is king. Cash flow is king. Cash flow is king. Be very aware of your cash flow, and then be very aware of where you're putting your assets to grow long term. So for the folks that are in the grind, take advantage of employer-sponsored retirement plans. If they're matching you and they're giving 4, 5, 6%, that's free money. That's literally free money, right? I like to say your money can work harder for you than you can ever work for your money. So let your money work for you. Put it into these investments. Put it into these types of accounts that can help you grow your money, so that you can focus on other things and focus on what you love to do, and then let your money work and do that stuff for you. I'll say that for the folks that are grinding. Depending on your income level, be very wary of taxes. Taxes can eat away at a portfolio. Depending on your income thresholds, look at municipal bonds. Municipal bonds are amazing tools. I had a client in Houston. They were both professors, and over time, he amassed about a $12 million muni bond portfolio. He literally started buying municipal bonds in his 30s when he was working as a professor. And over time, and just to give you an idea, municipal bonds average return, average yields anywhere between 3 and 5%. So if we do the math, it's generated about $600,000 of tax-free income just off of municipal bonds, right? And that's a nice thing to have when you're in retirement, not having to worry about, oh man, if I need 100, I need to take out 130. So look at look at the tax implications of the assets that you own for those that are grinders right now, those that are building assets. If you own real estate, if you own real assets, look at 1031 exchanges. 1031 exchanges are really neat. They allow you to like-kind exchange and not have to pay a big tax bite on real assets. Those are really cool things. And then for the folks who are retiring or in that space right now, focus on the protection side of your estate planning and of your financial plan. Here's what I mean. Typically when you're in your late 60s, mid-late 60s, right? That's when things start to really go south with your health. Things like long-term care insurance, that whole space is evolving and growing in such a neat way. You don't buy these solutions with money, you buy them with your health. I can't tell you how many times I've seen folks in their late 70s saying, hey, Mac, healthcare costs is a concern. What do you have to help pay for long-term care insurance? And what do you have? And sadly, they just can't qualify for it because they're too old and because they have health issues. So, depending on where you are in your phase of life, you're going to be focused on different things. I would say for those who are entering to retirement, looking at long-term care insurance, looking at the protection side, looking at the things that you can't get with money, but you can get with health is going to be really important.
Great. I know that was a hard one too, but I really appreciate you kind of giving us all this wisdom from kind of every aspect of the life cycle that our Terps are at. So we got a lot of thanks coming through the chat, and just want to give you a huge thanks, Mac, for sharing your wisdom with us. Just for everyone who's still on the line, this webinar was recorded, so I'll be sending out a copy of Mac's presentation and the webinar link once it's updated. So thanks everyone for tuning in and for sending your questions in advance. And Mac, anything else you want to say? And feel free to sign us off with the Go Terps if you want.
Sure. Like the financial life cycle is a long one. It is a complex one, but there are resources, there are people out there that can help you on your journey. Know that. And just know that the journey continues. So thank you all again. Go Terps.
Thanks, Mac. Go Terps. Have a good day, everyone.